Good evening, and welcome to the Global Economic Pulse. I'm your host, and tonight we are tracking a seismic shift in the digital commodity markets. For years, one asset has lived in the shadow of the king of crypto, quietly earning its title as digital silver. But tonight, the narrative is shifting from quiet stability to a high-voltage explosion. We're talking about Litecoin. While the skeptics are whispering about a collapse, the data tells a story of a coiled spring, one that is currently testing a 79 psychological floor before a potential state-sponsored launch into the stratosphere. Is this a breakdown or the ultimate buy-the-dip moment before a triple-digit breakout? The digital silver paradox Litecoin has spent the better part of 2025 navigating a tug-of-war between technical resilience and shifting market narratives. Currently trading near the 70.96 mark, it has established a rock-solid support zone between 74 and 76. Critics have pointed to its recent 44% decline relative to physical silver's 180% surge as a sign of a collapse, but veteran economists see a silver gap. Historically, when the gap between physical and digital silver becomes this wide, a massive rotation of capital follows. The China factor, the 100 catalyst, the real hook in today's market isn't just a chart pattern, it's a geopolitical pivot. Emerging reports regarding regulatory, yes, from China and the potential for increased institutional approval are fueling rumors of a 100 explosion. As China maneuvers through deflationary pressures, the appetite for high liquidity, low-fee assets like Litecoin is surging. With the Vanguard LTCC Spot ETF already gaining institutional traction in the West, a nod from the East could be the final domino to fall. The accumulation zone, whale wallets holding over 100,000 LTC have increased by 6% in the last quarter, signaling that the smart money is buying while retail is fearful. The resistance wall, analysts are watching the 84 to an 88 range. If LTC can reclaim this territory, the path to its previous local high of 140 and eventually the 200 institutional target becomes a mathematical probability rather than a hope. The fundamental floor, with 30-40 million lifetime transactions, and it has rate hitting all-time highs of 2.7 PHKs. The network is fundamentally stronger, bigger, and better than ever before in the high-stakes arena of global asset valuation. We are currently witnessing one of the most compelling anomalies in modern finance, the widening chasm between physical silver and its digital successor. For decades, silver has been the restless metal, a dual-purpose asset serving both industrial utility and a store of value. Yet, as we move further into a tokenized economy, the traditional ratio between these two forms of silver has fractured, creating a silver gap that is either a warning sign of a digital collapse or, more likely, the ultimate economic coiled spring. While physical silver has surged over 80%, driven by its necessity in the green energy transition and semiconductor fabrication, Litecoin has lingered near the 79 mark, appearing deceptively dormant. This is where the sophisticated investor finds their edge. Is it possible that the market has fundamentally mispriced the digital equivalent of a multi-billion-dollar commodity? If history is our teacher, the answer is a resounding yes. In traditional commodity markets, when a derivative or a correlated digital asset lags behind its physical counterpart to this extreme, the result is rarely a permanent divergence. It is a violent, mean reversion. Think of it as a rubber band being stretched to its absolute limit. The further the price of physical silver runs while digital silver stays pinned, the more explosive the eventual snap back becomes. This isn't just a trend, it's a structural imbalance waiting for a spark. The hook for the global economist lies in the utility arbitrage. Unlike physical silver, which requires massive logistics, vaulting costs, and assaying fees, the digital silver of the blockchain moves at the speed of light for fractions of a penny. We are currently observing a market where the more efficient, more liquid version of the asset is trading at a massive discount to the clunky, physical version. This value gap is precisely what precedes a 100 explosion. When institutional capital realizes it can gain silver, like exposure with 10th generation liquidity and zero storage overhead, the rotation will be swift and unforgiving for those left on the sidelines. We are not just looking at a price chart. We are looking at a fundamental mispricing of scarcity in the digital age. The question isn't whether the gap will close, but who will be positioned to profit when the digital silver narrative finally catches up to its physical reality. While the retail market remains fixated on the erratic fluctuations surrounding the 79 support level, a far more sophisticated narrative is unfolding beneath the surface of the blockchain. We are currently witnessing a massive, silent migration of capital, a phenomenon known as institutional absorption. In the world of high finance, volume precedes price, and the current on-chain data for Litecoin is screaming a message that the casual observer is likely to miss. While the headlines focus on the threat of a collapse, the smart money is effectively treating this price floor as a generational accumulation zone. Over the last quarter, we have observed a consistent, strategic increase in, addresses wallets holding upwards of 100,000 LTC. This is not the behavior of speculative retail traders looking for a quick flip. This is the calculated positioning of institutional entities building a fortress of liquidity. The real hook here lies in the liquidity paradox. In a healthy market, a price drop usually triggers a flight to safety, but in the case of this digital silver, the 79 mark has acted as a magnet for deep-pocketed buyers. These institutions aren't just buying the dip, they are effectively removing supply from the liquid market, locking it into long-term cold storage. This creates a supply-side pressure cooker. When you combine the entry of major players like the Vanguard LTCC spot ETF with the increasing scarcity of the asset, you create a scenario where the ask side of the order book becomes incredibly thin. Once the macro sentiment shifts, this lack of available supply means that even a moderate surge in buying volume won't just move the price, it will ignite it. Imagine a spring being compressed by a heavy weight. The heavier the weight, the more energy is stored. The market is currently in that state of maximum tension. We are seeing transaction volumes that rival the most active periods in 2021, yet the price is being held in a tight consolidation range. This is classic reaccumulation behavior. For the professional analyst, this isn't a sign of weakness, it's a sign of maturity. The market is transitioning from weak, speculative hands to strong, institutional ones. By the time the general public realizes that the 79 collapse was actually the foundation for a triple-digit breakout, the window of opportunity will likely have slammed shut. The question for the savvy observer isn't whether the price will move, but rather, when the institutional dam finally breaks, will you be holding the asset or just watching the chart? Would you like me to provide a deep dive analysis into the China approval catalyst and how it might act as the final trigger for this institutional supply squeeze? In the complex machinery of the global economy, few variables possess the explosive potential of a geopolitical policy pivot, and right now, the eyes of every major institutional desk are fixed firmly on the East. The China factor represents far more than just a regulatory shift. It is the potential reopening of the world's most potent liquidity spigot. For years, the narrative of a blanket ban in mainland China has acted as a psychological ceiling for assets like Litecoin. However, as 2025 progresses, the economic reality in Beijing is changing. Facing persistent deflationary pressures and a cooling property sector, Chinese authorities are increasingly signaling a strategic detente, with digital assets utilizing Hong Kong as a sophisticated regulatory sandbox. This is the ultimate macro hook. We are seeing a transition from total prohibition to controlled liberalization, and Litecoin, with its deep-rooted history in the region and its status as a non-security commodity, is perfectly positioned to be the primary beneficiary. The economic logic here is undeniable. When a massive economy like China's begins to integrate digital commodities into its broader financial framework, even through secondary markets like Hong Kong's new stablecoin ordinance, it creates a massive demand-side shock. This isn't just about retail speculation. It's about state-backed entities and massive tech conglomerates looking for hard, digital assets to hedge against currency volatility. Historically, when China sneezes, the global commodity markets catch a cold, but when China buys, the markets ignite. The rumors of institutional approval for digital asset initiatives in the East are the silent drivers behind the current 79 price floor. Investors are essentially front-running the possibility of a state-sanctioned liquidity injection. Consider the global liquidity cycle. We are at a juncture where Western institutional interest, evidenced by the filing of spot Litecoin ETFs by giants like Grayscale and Canary Capital, is meeting an Eastern regulatory thaw. This convergence is the spark for the projected 100 explosion. If even a fraction of the capital currently trapped in China's cooling traditional markets rotates into the high-velocity, digital silver ecosystem, the current resistance levels will be obliterated. We are no longer debating if China will participate in the digital economy, but rather how they will choose to flip the switch. For the professional strategist, the China factor isn't a speculative gamble. It is a fundamental realignment of global capital flows that makes a triple-digit Litecoin price target look not just possible, but mathematically probable. Would you like me to analyze the specific technical resistance levels between $80 and a 100 to identify the exact ignition point for this breakout? In the competitive landscape of digital commodities, an asset's true economic value is often hidden within its physical infrastructure, and for Litecoin, that infrastructure has never been more formidable. While critics point to the 79 price point as a sign of stagnation, the network's has rate, the total computational power securing the blockchain, has surged to a staggering all-time high of 2.7 PHKs. In economic terms, this represents a massive security moat that is increasingly expensive and difficult to breach. We are witnessing a divergence between market price and network strength that creates a high conviction hook for professional analysts. The cost of production is rising while the price remains pinned, a classic precursor to a supply-side squeeze. When the has rate hits record peaks during a period of price consolidation, it signals that miners, the most informed stakeholders in the ecosystem, are aggressively investing in hardware and energy, betting on a future price explosion rather than a collapse. This record-breaking security isn't just a technical metric. It is the fundamental engine behind institutional trust. For a 100 breakout to be sustainable, the underlying network must be unassailable, and at 2.7 PHKs, Litecoin is arguably one of the most secure proof of work assets in existence. This level of robustness effectively de-risks the asset for large-scale institutional players who prioritize network stability over short-term volatility. We are currently in a security price mismatch phase. Historically, price tends to follow has rate because as the network becomes more secure, it becomes a more attractive vessel for high-value settlement and store of value applications. The digital silver narrative is being reinforced not by marketing, but by the raw industrial power of the global mining fleet. Moreover, this rate explosion acts as a definitive counter-narrative to the idea of a digital collapse. You do not see record-breaking capital expenditure in a dying network. Instead, we are seeing the industrialization of Litecoin mining, where only the most efficient and well-capitalized operations can survive. This consolidation of mining power into professional hands creates a floor for the asset. Miners will not sell at a loss indefinitely, effectively creating an economic price floor near the current 79 support. As the difficulty to mine each coin increases, the fair market value is forced upward. For the savvy investor, the current consolidation isn't a sign of weakness. It's the sound of the engine being tuned for a triple-digit sprint. The network is bigger, faster, and more secure than ever before. Now the market price is simply waiting for the inevitable moment of catch up. Would you like me to analyze the scarcity and halving cycle lag to show how this record has rate intersects with the dwindling new supply of LTC? In the calculus of global supply chains, scarcity is the ultimate arbiter of value, and Litecoin is currently navigating a sophisticated post-halving supply lag that most of the market is dangerously overlooking. Historically, the reduction of miner block rewards from 12.5 to 6.25 LTC, a milestone reached in late 2023, does not manifest as an immediate price spike. Instead, it acts as a slow burning fuse. We are now in the critical 18 to 24-month ignition window, where the daily sell pressure from miners has been structurally cut in half. Yet the secondary market is only just beginning to feel the inventory vacuum. This is the hook for the macro investor. While the price appears consolidated at 79, the actual circulating supply is being systematically thinned out. In a world of infinite fiat printing, an asset with a hard cap of 84 million and a dwindling issuance rate isn't just a currency, it's an economic insurance policy. The true engagement factor lies in the absorption ratio. As of late 2025, over 91% of the total Litecoin supply is already in circulation, leaving fewer than 7.5 million coins to be mined over the next century. When you pair this extreme scarcity with the reality that lifetime transactions have surpassed the 340 million mark, you see a network that is growing in utility while its new supply pipe is being squeezed shut. This is a textbook supply-demand imbalance. In traditional economics, when the velocity of money increases on a shrinking supply base, the result is an inevitable vertical price adjustment. We are currently watching the quiet before the shock, where institutional demand from spot ETFs is beginning to compete for a pool of coins that is no longer being replenished at the same rate. Is the 79 floor a sign of a digital silver collapse, Or is it the final accumulation phase before the scarcity-driven explosion to 100 and beyond? The data suggests the latter. We are seeing a liquidity desert forming on exchanges where available LTC reserves are hitting multi-year lows. This means that when the next wave of China approval or Western institutional buying hits the order books, there will be no supply to absorb the impact, leading to a violent move to the upside. For the professional trader, the post-halving lag is not a period of boredom. It is a period of high conviction positioning. The math of 84 million coins is unchangeable, and as the supply lag ends, the market's realization of this scarcity will be the catalyst that turns the digital silver narrative into a triple-digit reality. Would you like me to move on to key point 6 and analyze the psychological pivot at 79 to see how it triggers the automated FOMO? By orders, we wrap up tonight's economic update. The question remains, are you watching a collapse, or are you witnessing the final moments of a deep value accumulation phase? The digital silver narrative is no longer just a slogan, it's a high-stakes economic reality. If China opens the gates and the ETF momentum holds, the 79 floor we see today may soon be a distant memory in the rearview mirror of a 100 rally. Stay sharp, stay informed, and remember, in the world of economics, the loudest gains often come after the quietest periods. I'm Gemini, and this has been your Global Economic Pulse. Good night.